Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back once again. Hey, just wanted to start off saying thanks to everybody that came out for the workshop on Thursday night. Hope it was helpful. We're going to be talking at the workshop. I got ideas for the next workshop, and I think you'll like it. I haven't really set the date yet, but we're going to be talking about individual securities and how to pick big winners or stocks that have the potential to be big winners, because you're really not allowed to say stuff like that when you manage money, because some people might take that as a guarantee, and the only guarantees in this world are that there are no guarantees. That's the guarantee you get. There are no guarantees. The guarantee is only as good as the people standing behind the guarantee. There's a lot of people, there are an awful lot of products out there that say guaranteed by who? You can buy treasury bonds. Those are guaranteed. Those are guaranteed by the U.S. government. And since the U.S. government owns their own printing presses and can print the money and pay you, that's pretty good. That guarantee is pretty good. Also guarantees that at some point in time you have higher than normal inflation, but if they keep doing that, if they abuse it. But bottom line is, the guarantees are only as good as the companies standing behind them. And so you've got to watch out, be careful. It's rough out there. Anyway, so I thought we would talk today about individual securities. And we're going to talk about knowing your investment strategies very, very well. I got to tell you, people spend more time planning their vacations than they do planning their investments. As a general rule, that's how it works. And, I kind of understand it because there is an awful lot of material to become familiar with. And it can seem it is overwhelming. I mean, I'm amazed. So one of the goals of this show is to try to bring a lot of, shed some light on the information, basically cut down on the learning curve for people that, trying to learn to invest. And incidentally, investing, as far as I'm concerned, is the second most important thing that you need to learn to do financially. Be successful financially, you got to do two things. Two things. All you need to do to be successful financially. First is you got to learn to live beneath your means. I can't really help you with that. I can give you a budget worksheet, which I sent some copies out of last week, to help you on the right path, but you're actually going to have to do that work. I can help you by showing you a budget, having you write that stuff down, and then you can see where the money's going. That's the first thing, but pretty much that's something that's going to be up to you. You're going to have to learn how to live beneath not within your means, beneath your means. See, living within your means you're not spending as much as, within your means you're not overspending. You're not incurring debt on a credit card. You're not buying too much house. Car payments aren't too large. That's living within your means. Living beneath your means means you've got a fairly substantial amount of money to be able to invest each and every month out of every paycheck. And it's a habit. It's a habit. You've got to get into the habit. We're not going to talk much about that going forward because I think that's pretty much common sense. I mean, who in the world expects to be able to live one day if they don't save any money? I can tell you who expects to live without saving any money: the people that are supporting Bernie Sanders. No, I'm just kidding. Kind of. But I'm just kidding. I really am kidding. I don't even know anything about I've only seen 5 minutes on this guy. I don't study much about the politics. I do study the economic policies of the people that are coming close. Not that it's going to matter too much, because basically Congress and the government's going to do whatever the government's going to do. And quite frankly, unless you're a big multi-billion-dollar corporation, it's not going to matter. It's really not going to matter too much, especially, and if you're looking at it in investing, then it's really not going to have a big impact on you. If you're investing the right way, the economic policies are not going to have nearly the impact that you think they will. They just won't. And I answer so many questions on this stuff. Well, what do you think this is going to do in London? And England's going to pull away. You know what? What do you think it's going to do? The corporate tax is going to. Well, I can tell you, everything is always changing, and it always will be, and it always has been. Nothing has ever been identical, but there are some basic theses that if you stick to, you generally do very well. So that's what we're going to talk about. What are those things? What types of companies? What types of strategies do you use for investing? Mutual funds. What kind of mutual funds do you want to use? Mutual funds, by the way, are harder to pick than stocks are by far. Mutual funds are not easier to pick by stocks, and the vast majority of people think that it's easy to analyze mutual funds. They think it's easy because all they're going to do is look at the past performance and the fees that they charge. Well, let me save you some effort there. Forget tracking the fees. It's not worth your time because when the fund reports its performance, it's net of fees. Did you hear what I said? It's net of fees. The reason I take that tone of voice, and I'll stop that now. In fact, I'm going to try never to take that tone again. But the reason I do that is because I've been bombarded with that over and over and over again, and it is inconsequential. It doesn't matter how much you paid. It's how much you left the arena with. So if the track record includes the fees, I don't ever want to have to repeat that again. And if you want to call in and get smarter like you, well, how much are the fees? You know what? I'm just going to hang up on you. That's the way it's going to work. I'm not going to get mad. I'm not going to give you a lecture. I'm just going to hang up. So do whatever you want. This is America. But that's get frustrating, answering that question over and over again. And or somebody comes up and says, well, how'd you do? And then, well, how much you charge? Okay. If I show you one of my models through Folio, one of the runs I'm running that has real money in it, the fees are in there. Okay, so it doesn't really matter. When you're looking at a mutual fund, the fees are in there. So it doesn't really matter. And by the way, performance, not only is it not guaranteed to happen in the future, I can tell you it's not going to happen exactly the same way as it did in the past. And you need to come to grips with that. So it's kind of like somebody who's learning to play golf for the first time or is golfing for the first time. And you try to show, actually, investing is a lot more like skiing. I don't know if you've ever skied. Probably not if you're under the age of 25, because the last 10 winters, you haven't been able to ski much in Ohio at all. So if you have never skied, the chance of you having started in the last 10 years, pretty remote. But if you ever do, it's very fun. And you can learn fairly quickly. You get the basics down really fast. By the way, if you want good deals on ski equipment, Buckeye Sports, look them up online. They're a local company. In fact, I have a pair of skis that I bought 3 years ago there that haven't seen the slopes because there hasn't been enough snow. And got a good deal, though. I got a great deal on them. Hopefully one of these days I'll get to use them. But so anyway, you learn to ski fairly quickly. You can get down the hill. You can learn to stop. You can learn to turn. You start off on the smaller hills, and then you work your way up. But you can learn to ski relatively fast. That's one of the things I like about it. And actually, if there were more snow, I'm sure it would be a lot more popular than it is. So anyway, when you learn to ski, you learn how to get down the hill. You learn how to stop. You learn how to get up because you are going to fall. And then you just take off and you start skiing. The more you go, the better you get. The more frequently you practice, the better you get. And that's kind of what investing is like. You can learn the basics. You can learn how not to kill yourself right off the bat. That's what the next workshop I'm doing, that's what we're going to be talking about. How do you not kill yourself? The investment strategies. How do you not kill yourself with an investment strategy? Well, first of all, the first thing you need to do is learn the basics about your strategy. It's like learning to stop with skis. They tell you to point your toes in together. Makes like a V. It slows you down. And same thing. If you're looking at stocks, hey, If you're new to stocks, my advice, don't invest in a stock that's got more than 20% debt relative to the amount of equity in that company. Well, that's equity. That's money that people paid into the company or the company paid themselves when they kept part of their profits. Okay. So if the debt is more than 20% of the asset value, also known as equity, then stay away from it. You know why? Because companies that have a lot of debt have a tendency to go bankrupt when business gets bad. Ask the GM shareholders. Ask the Kmart shareholders. Ask the Enron shareholders. Yeah, you think I'm just picking on those guys. There are thousands of bankruptcies in publicly held companies. So if you don't want one of the companies that you're investing in to go bankrupt, what do? You avoid those companies that have a lot of debt. So that's one of the basics. One of the things that will keep you out of trouble and keep you alive when you're learning to invest. Because as I alluded to the first part of the program, there are two things you need to know to be to be successful financially. First is you got to learn how to live beneath your means. Okay, the second one is you have to learn how to invest. When you have your own little portfolio, it might be big. When you've got your own portfolio, you've got to learn. It's a business. You are literally learning to run a business, your own investment management business. You're running a business. You're going to buy inventory, stocks, bonds, mutual funds, CDs, whatever. You're going to manage that, or you're going to hire out a subcontractor to help you select investments, to help you manage that. But it's your money. It's your business. You should treat that like a business. Now, fortunately, it's really not as hard as a lot of the people want to make believe it is. It's really not. That's really the basis of this show. Trying to help investors do better. Why would I want to help you do better? Won't that take business away from me? No, because I'm one of those subcontractors. There's a lot of labor involved. And unless you have time to do it all yourself, which means you are completely retired and you have a lot of interest. If you don't have a lot of interest, you're not going to spend the time. So that means that the vast majority of people who don't have a lot of time and don't have a huge interest doesn't mean that you get a pass. You still need to know how to do it, but you're going to do it intelligently. You're going to go out and you're going to find people like me who can explain things and show you what you need to be doing. Give you the basics, the fundamentals. That's what we like to do. That's what we like to do at Bullington Capital. Let's get the basics done and do those very well. Try to do those very well. You do that long enough, over time, you end up getting pretty decent results. And a lot better than you can by going about and studying expense ratios and returns. That will get you nowhere. Actually, that'll hurt you. Looking at returns and expense ratios, if that's all you know, you're destined to be one of the 19 out of 20 individual investors who ends up getting beat by your average balance fund. Think about that for a second. 19 out of 20 people end up getting beat by an average balanced fund that try to manage their own money. Why is that? Why? I can tell you. Because the first thing they look at is what's the performance? And generally, they're looking at the 1, 3, 5, and 10-year track records. The vast majority of it, the best performers, by the way, are always the ones that have done the best over the last 18 months. It lifts those longer-term averages up. So you got to look at that. That's something that you should probably know. You should know that. If you're looking at mutual funds, you better find out who's managing the fund. You better find out how long they've been there. And if you're going to look at the track record, you only want to look at the track record of the current manager for the time period that they've been managing the fund, because before they got there, they weren't managing the fund. That's not their track record. That's someone else's track record. Okay, so that tells you nothing. Looking at the 10-year track record and the manager's only been there for 2 years, good luck. Yeah. So there's a lot to that. There's a lot more to manage. Picking mutual funds is significantly more difficult than picking stocks. Significantly more. That's why I like exchange-traded funds. Those are professionally managed too, most of them by computer. They tell you exactly what they're doing with the money. Not I'm going to buy stuff based on my experience and knowledge, which can be good if you manage to locate a good portfolio manager and stick with them through thick and thin. The chances are, portfolio manager has a lot of success. He's moving on. Why would a mutual fund manager not go in and start his own hedge fund when he can get more than, the compensation can be astronomical in a private fund relative to a public fund? Not many people who manage public funds stick around for that long. That's one of the reasons it's so hard to identify a good manager. When a good manager starts, he doesn't have a track record at all. By the time that good track record is there, most of those guys are leaving on to bigger and better things. They want to be rich too. So that's what makes mutual funds so difficult. Exchange-traded funds, on the other hand, actually lay out in their prospectus exactly what they're going to do with the money. They tell you what they're going to do with the money. Now, it's been interesting. There are some new exchange-traded funds where the people are picking stocks like they used to do with mutual funds. Yeah, I get it, but I would probably stay away from those too. I'm going to stay away from those. I've never invested in one of those, and I never will. I like to know exactly what's going on with the money. That's a key. You go to my website. There's an overview of two of the more popular strategies that I use, the high dividend model and the momentum model. Those are overviews. Those are just to give you a basic idea of what we're doing. The full explanation is what we go through in the office if somebody decides they want to come in and talk to me about it. You want to come in and talk to me about it? I'll show you behind the curtains, and you can see the Wizard of Oz. Notice that the wizard's kind of short. Just kidding. We have no wizard there. Yeah, but I'll show you the rest of it. And it's very important that you understand that. It's very important. There isn't a single solitary strategy that always wins. There isn't one. Most of the really good strategies will lag the market, sometimes for 2-3 years in a row, sometimes longer. But the vast majority of strategies, if they have any merit to them at all, are going to outperform over certain time periods. And you need to know that most of the time, if at least 50% of the time, there's a really good chance that they're underperforming the market. Like I said, sometimes 3-4 years in a row. We'll talk about why that's so challenging right after these commercial messages. Listen to Bill Bullington right here on 1420. Stay tuned, because I'll be right back. And we're back. Hey, if you have a question, feel free to call us, 216-901-0945, 216-901-0945, 216-901-0945. I thought I would talk about the actual strategies that we run at Bullington Capital, something that I think is very important. I know it's very important. You can't win in the financial markets if you're not comfortable with what you're doing. And the only way you can get comfortable with what you're doing is to learn as much about it as you can. That's how you get comfortable. And by the way, it's still relatively uncomfortable until you've been doing it as long as I have, and you just get used to it. That's what happens. You get used to it. But you got to prepare. I think it was Vince Lombardi. Now I'm really aging myself. He had already retired a long time before I'd ever started playing Pee-wee football. But Vince Lombardi came in. And Vince Lombardi had said, everybody's got the will to win. When it comes right down to it, everybody has the will to win. Most people don't have the will to prepare to win. Now, I'm actually, those are my words, my interpretation of what he said. But essentially, that's what he was talking about. The will to prepare to win. It's not in the middle of, you don't want to wait until your money's at risk to try to go back and learn what you're supposed to be doing. You want to spend some time ahead of time getting to know what you're going to be doing. What kind of tactics are you going to use? What can you expect? That's a big deal. If people knew what to expect, they really wouldn't have nearly as many problems. 19 out of 20 people wouldn't do worse than the average balance fund. 19 out of 20 investors, according to Dalbar, do worse than they would if they just put their money in a balanced fund and left it alone. Can you imagine that? All that effort, all that aggravation, all the stress, looking at their 401k plans at home. Oh, it's going down. You could eliminate that. And so that's what we're trying to do here. Help people become better investors. Like I said at the beginning of the show, 2 things that will help you become financially successful. Learn to live beneath your means, and then learn to invest. There are other ways, obviously. I mean, you can become an athlete. You could become a movie star. You could build a business that's very successful. Those are all different ways of becoming financially successful. They all have different sets of challenges. None of them are easy. But at some point in time, even those people need to know what you need to know, and that's how to invest, how to be an above-average investor. When I say above average, I'm really not setting the bar that high. The average investor really doesn't do that well. And there are lots of reasons for it. We're not going to go into that, but I'm going to tell you that it's a lot easier than you might think it is. First thing you need to do, familiarize yourself with the actual strategies that you're using. That's why it's so difficult to pick mutual funds, because they're not as clear about what they're actually going to do with the money. So you don't really know what they're doing. Peter Lynch, 2 out of 3 people that invested in the Magellan Fund when he ran that fund. The reason I keep bringing that out is because that was the most successful mutual fund as far as the track record goes of all time. A publicly held mutual fund. He's got the best record. It was $10,000 invested when he started running the fund. 13 years later, when he retired at a ripe old age of 46, by the way, was worth $330,000. Think about that. 2 out of 3 people that invested in that fund while he was running the money managed to lose money. How is that possible? Well, I can tell you how it's possible. It's because they didn't understand what he was doing. They didn't really know that, hey, this thing is going to be really volatile because it's mostly stocks, and stocks are really volatile. That's what they do. So had they known that, the third of the investors that understood that got fantastically good returns. Actually, they even got good returns a few years after he quit. Then the fund got too big. That's another radio show. Well, anyway, you really need to understand what the mutual funds are doing, what the money managers are doing with the money. By the way, you would have had to trust him implicitly, because that was before internet was popular and people really couldn't follow up. They really didn't know how to follow what he was doing. They just looked at the track record and said, okay, we're just using the track record. So anyway, I'm going to take a phone call here. If you'd like to call in, 216-901-0945, 216-901-0945. And I got Jerry.
Good morning, William.
Hey, how you doing?
I'm doing well. Yourself, sir?
Pretty good.
All right. Well, I want to start out and ask you, within the last month or so, obviously the market's taken a bit of a pounding. Mm-hmm. What opportunity in sectors, what looks good to you currently, or what might be promising?
Well, I like the same one I've been getting my, handed to me in.
Okay, I didn't want to lead you into that, but okay.
Yeah. And this is something we talked about at the workshop on Thursday. Was what if I described an entire industry where the growth was better than 10% year over year, where the dividends had been raised on average over 10% year over year, the yield was 5% tax free. Mm-hmm. What would you think about that?
Well, I'd certainly be interested.
Right. Now, if I told you that the yield is 10%.
Yeah.
You know how yield goes from 5% to 10%?
Absolutely. Lost half their value.
That's exactly right. So I still think that's one of the better opportunities.
But isn't there a chance that these companies are going to get wiped out, or that there's going to be a situation in which they're going to be written down to nearly nothing?
There's always a chance for every company to do that. That's not, and these guys are no more subject to that. In fact, I would argue that many of them are highly insulated against that sort of thing. Can it get nasty? Yeah, it can get nasty, and that has already been factored in my opinion, to the share prices.
Okay.
That's because you've cut them in half, man. You cut them in half.
It's been absolutely brutal.
Yeah.
I mean,
So even if they end up having to renegotiate their contracts at lower rates, which they're not going to go too much lower because, quite frankly, they don't have to. They really don't have to. Do you know how expensive it is to get a pipeline put into your wellhead?
no, I have no idea.
I
can't imagine it's cheap.
It's not cheap. And so the alternative to the oil companies who may not be drilling as much as they were is to get another pipeline company to come in and put a new pipeline because they can't.
Yeah, I see what you're saying. Replacement value.
Right. Yeah. And, the company that put the pipeline in there owns that pipeline.
Yeah.
The oil company can't have it. And they're not going to wait. Are they going to wait for the months that it takes to get approval to put a new pipeline in because these guys, still want to make money on delivering the goods that they're pulling out of the ground?
Yeah, definitely put over the barrel.
Yeah, and so they do have a much better position than most creditors. The vast majority of creditors are going to come after these guys.
Yeah.
And on a pecking order, when they're looking at when they do a bankruptcy reorganization, these guys are going to be one of the higher ups. They're not going to be one of the last people.
Okay.
So it depends on the individual companies. What are they going to be doing if they file for bankruptcy and then they stop making payments and they have to wait until the bankruptcy is over before they start back up again? Yeah, that's going to cause some problems for the smaller pipeline companies, especially the ones that only have a handful of contracts. If you get a handful of customers and 2 or 3 of them go bad, that's bad.
Oh, yeah.
But
Kinder was one of the big ones that really got bruised.
Mm-hmm.
Do they? I mean, what's their? I haven't even followed them as of recent, but have they had any rebound at all?
Hang on a second. I'll pull it up. I'm pretty sure it not too much. It doesn't look like it's come up off the bottom a little bit. Well, it's come up by about 50%. That's not little.
I'd hate to think what it was before.
Yeah, it was really high. So I'm looking at the prices. We're around $44. It got all the way down to $12.55. Now it's just right around 17 3/4, almost $18. So it's up almost 50% off of its bottom.
So it got down to 12 within the last couple of months.
Yep.
Good.
You imagine that? So, and by the way, they converted. They're not an MLP anymore. They're a publicly held company. So they converted. The dividend yield at it right now is 9%, but they do have a lot of debt, and there's been everybody's afraid. This is not something that I would consider easy. And I got to tell you, Jerry, the next workshop I'm doing, I learned how to do some scans on Bloomberg, and I'm going back to my roots. When I first started in the business, I did mostly value-oriented stuff with small-cap companies.
Okay.
It was a lot easier and a lot safer back then to do that sort of thing. And now, what's interesting is if you watch what's happened in the markets, it's actually come back. That's going to come back in vogue. Looking for those companies who have really been beaten, big time, whose financial statements, whose balance sheets are strong. Oftentimes, these smaller companies, their share prices will drop larger because they've only got 10 million, maybe 50 million shares outstanding. They don't have billions of shares outstanding. So 1 or 2 days of a big mutual fund selling a stock like that, and they're going to get beaten badly.
Catastrophic, yeah.
And oftentimes what happens is you'll get some of these micro-cap funds that come out that have a good track record investing in stocks like these. Then they get too large to be able to continue to do that. But before they get too large, the interesting thing is the learning experience by the portfolio managers that are managing these funds is coming at the expense of the investors in the funds when they try to unload those small stocks that they purchased a couple of years ago. They will beat the price down in many cases 50% or more just trying to get out. And so and oftentimes Peter Lynch talked about that 25 years ago, the first book he wrote. He talked about that. He had to be very careful, and oftentimes he would be the prices would get so low that they became a good value again, and he would start buying them back. So that was just one guy with one fund who had that kind of capability. And so that's opened up opportunities now for people that really know what they're looking for. You can get into some of these smaller companies. And when a small company doesn't have any debt, it's got a ton of cash on hand, and is selling at or below its liquidation value, you know what generally tends to happen there?
It's starting to get attractive.
One of three things happens. You can get some knuckleheads in there that blow through all their cash and force them into bankruptcy. Okay, that's fairly rare that happens. The other two scenarios are earnings pick back up, the stock gets popular again, and the share price goes up.
Yeah.
The third scenario is somebody like Warren Buffett comes in and buys the company. There are tons. You've probably heard the term private equity. Everybody that sells a business today decides that they're either going to invest in a family office who shows these obscene returns by buying private companies. Whether that's true or not remains to be seen, but it's a popular thing to do. And what they're doing is they're going around and they're looking for these types of companies that they can buy, and they get to keep the cash.
Mm-hmm, mm-hmm.
So if you know what they're looking for, then you can go out and identify that yourself. And that's what the next class I'm teaching is going to be about. It's going in places where the big mutual funds are not going to be able to go.
When are you going to be having this class, Bill?
Actually, I forgot.
That April or?
I think so. Hang on a second. I'll see if I can pull it up here. I was just talking with my marketing director about it, and I can't remember the date. Shoot. It's going to be the next one, probably either end of April or early May.
Okay.
But it's really cool because, again, things have changed a little bit. Market cap weighting is dominating the big fund industry. I mean, it is dominating. They're throwing their hands up in the air and saying, we quit. We're joining the crowd. We're going to we're going to put more money in the stocks that just went up the most. We're going to take money out of the stocks that just went down the most. And so that's one of the things that actually creates some of these inefficiencies that hopefully we'll be able to exploit every once in a while.
Yeah.
Okay. It's not up yet. The date's not up yet. So it's probably in the next 6 to 8 weeks.
It'll be the next class you have, though.
Right. Yep.
Okay. Very good. Very good. So, all righty, William, you have a great weekend, and thank you so much for your advice.
Oh, thanks. You too.
Bye now.
Bye. If you'd like to call 216-901-0945, 216-901-0945. Now, I said at the beginning of the show I was going to talk about my high dividend model, or one of my models. And so I'm going to pick that one. That's one that I kind of planned on. And it's really important. It's really important that you get to know that. In fact, there's a lot of similarities in that model and to what I was just talking about with the smaller size companies. This particular investment model selects stocks from large companies. These stocks are within the top 10% in size of all the companies listed on the stock market. And I look at the 10 major sectors that make up the stock market, and I'm looking for those 4 stocks out of each one of those 10 sectors that pays the highest current dividend, or where the current dividend yields the highest. Now, dividends are a function of cash. You pay dividends out because of cash. I've got to take a real quick call here. Or no, I don't. I guess that was a mistake. Sorry about that. If you would like to call 216-901-0945. But anyway, the cash that you are generating, that you pay out as a dividend, is one of the reasons people buy stocks. Now, when somebody gets afraid, or the investing community doesn't like what a management has to say about the current outlook over the next 12 months or so of a particular company, oftentimes the company share price goes down. Sometimes it goes down a lot. Sometimes the problems are even bigger than that, and they're very real. Many times the investing public, the professionals, will actually overreact. A computer model that uses regression analysis will overreact. That's one of the reasons it helps to understand your computer models, the ones that you're investing in, because none of them are perfect. And when you know which the more popular ones are, you can tell where their inefficiencies are and try to take advantage of that. This model is designed to try to take advantage of some of that. Occasionally, a problem will be real, and that may be the end of the company. That's why you've got 40 stocks, because if you're buying 4 stocks from each of the 10 major sectors, that's 40 stocks. When we come back, we'll show you how that helps you protect yourself from companies that go bankrupt. Right here on 1420 The Answer. It's Bill Bullington. I'll be back after these messages. We're back. So I was just talking about the high dividend model that I'd run, and I take the 10 major sectors that make up the stock market. I look at the biggest companies within that. They're definitely within the top 10%. And I'm looking for those that have the highest dividend yields. Now, when I say that, I'm telling you right now, an awful lot of people hear the high dividend yield and their ears perk up. Not to rain on anybody's parade, but the reason the dividend yield is so high in many cases is because the share prices are down. So it's a little spooky when you actually look at you listen to the strategy. Oh, those with the highest, that sounds great. Okay, but let's examine why they're down there. Because the share prices are depressed. Share prices have gone down. Company's got some sort of a problem. Generally, more often than not, that's what happens. That's why this is so difficult. And that's why you need to hear what I'm saying right now before you start to invest in something like that, because I think it's safe. I think it gives you a really good opportunity to earn excellent returns over time if you're patient, but you have to know what to expect. Some of the names of the companies in that list probably scare you a little bit. But I want you to also think of this. I've thought of that. I've thought of the fact that some of those companies are going to have real problems and may not make it back. That's why I'm only putting 2.5% of that portfolio in each one of those stocks. Only 2.5%. We're going to spread it out. It's called diversifying. We're going to diversify the portfolio. And some of the companies are actually going to recover, and the share price is going to go up. That's where our big capital appreciation comes from. In the meantime, we're getting paid a dividend to wait. So that's kind of cool. You know what? I'm going to have to continue this conversation in a couple minutes because my buddy Tom from Basista Furniture is online. And there you are. Hey, Tom, how you doing?
Good morning, Bill. How are you?
Pretty good.
Great show as always, but most of all, how about the stock week? We had a positive week. I'm happy.
Oh, yeah. I hate to say this, but I'm really optimistic for the rest of the year. But there are things that are falling into place. You know, the big discount in oil prices has given people a lot more cash, and some of those people are actually going out and buying some furniture.
Absolutely. And one thing I like to say that we're always the innovator in things. We tagged the entire store yesterday. Anyone comes in today, March Madness sale. Most people have a March Madness weekend. We tagged the entire store 35 to 55% off, and we're keeping the tags on till the end of March. How about that?
Wow. Wow.
Plus, as you know, we're the only store in Northeast Ohio, to my knowledge, with free delivery. We'll deliver 90 miles away at no charge.
And I'll tell you.
And we'll even bend the rules. Actually, this Tuesday I'm going to Columbus. We'll even bend the rules and still not charge.
Yeah, and those guys do such a good job. I can't tell you, Tom. I had been shopping at your guys' store at least 10 years before I ever met you. And,
I was going to say, I think you've been coming for 25 years.
Yeah.
Not more.
Probably. Yeah. Actually, now that I think about it, oh, man, that's depressing. Do you know how old that makes me?
Yeah, I'm older. How's that?
Yeah, but it is awesome. I really like the new website too. That's awesome too. That is the
Yes, yeah, I'd like to mention that also. We just updated our website, and it just happened last week. So anyone who goes to assistant.com, it's so much more efficient. It shows inventory that we have on site. I'm having people call and say, "I really love that entertainment center by Hooker that you have in display in the warehouse. I'll take it." I'm thinking, "Holy cow, we never did that before. Before we were just doing a catalog of everything, which we're still doing, but we're also now showing in-stock merchandise for ASAP delivery, which is real positive."
Oh yeah, that is awesome. And I will tell you, if you don't see it on the website, don't give up. Call these guys because
Absolutely. Yeah, people think, you carry one or two lines. I couldn't tell you. We have to have over 1,000 vendors. So we basically have access to anything. And then people pull in our store, and they say, "Oh, it's a nice little store on State Road." It's an entire city block, 2 floors. People walk their maze, 45 minutes, they're still walking. They say, "I can't believe how much furniture you have."
yeah,
It pulls you from the outside.
absolutely.
But anyways, the whole store is tagged. Today we're open till 6 p.m. Tomorrow, Sunday, 12 to 5. During the week, we're there 10 a.m. to 9 p.m. So please stop in. One thing I would like to say, we made a record buy. We purchased 350 different lamp styles at a furniture show on close-out great prices. So if you would walk through our store now, everyone could use the new lamp. We also actually bought over 200 paintings. So as far as accessories, lamps, and pictures, I guarantee we have a better selection than anyone in the state of Ohio, not only Northeast Ohio. So we've got a huge selection. And then, of course, Amish bedroom sets, American-made bedroom sets, living room, dining room, sofa lofts, you name it, we have everything.
And I can't tell you how much I appreciate you coming on the show too and making these offers available to the general public because that it is an excellent deal. You're not going to find a better deal, in my opinion.
I appreciate it. We don't, we're on TV occasionally. We're not like the other stores, the big box stores that just blast away. Their whole profit is in advertising. We're the opposite. We're word of mouth, we're referral. We'd rather give you the value, with this huge savings that we offer in high-end quality furniture.
Yep. Well, that sounds great. Hey, Tom, I really appreciate you
calling.
calling.
Have a great weekend. Good talking to you, buddy. Take care.
You too. All right, have a good one. Yeah, it's Persistent Furniture. And I'm telling you, I've gone in there for forever, and I had no idea. That was actually started by Tom's father, and he started a long time ago. I mean, we're talking about, I don't know, 80, 90 years ago. And so these guys, one of the reasons that they're such a good deal is that they own the facility. It's been paid off, decades ago. So their overhead is significantly lower, and they pass along a lot of those savings to the customers. Anyway, persistentfurniture.com, check it out. Anyway, back to what I was talking about. Yeah, in fact, value investing, the high dividend model, Bullington Capital. So we're looking at stocks, big companies, been extremely successsul because you don't get into the top 10% of companies by size by being not good. You've got to be at the top of your games to make it into that group. There's companies that pay dividends. Something happens oftentimes with the company that causes it to go down in price. You've always heard buy low and sell high. Well, how do you know where low is? Well, this is one of the ways of kind of trying to gauge where low might be. Because the dividend yield goes up when the share price goes down. Let's take an example. Let's say you got a stock that's $25. All right, let's say it's $50. $50 stock. It's got let me see, what would be a good dividend yield on it? Now, let's start at 100 and keep the math simple. Got a $100 stock, and the dividend yield on it is $2.50. You get $2.50 in a dividend, which is really good because the dividend gets taxed a little bit lower than the interest on a CD, and the interest on a CD is going to give you about less than $1 worth of interest over a year. So what would you rather have, $2.50 or $1? $2.50 at a lower tax bracket, or it gets taxed lower, or $1 or less than $1 that's fully taxable. Now let's say that $100 stock drops to $50 because something happened. Maybe business slowed down. Maybe they're going to have to spend some money where they didn't know they were going to have to spend money. Whatever. There could be millions of reasons. People look at that and they go, oh, well, the earnings per share are not going to grow as fast as we thought they would. Or maybe they're actually going to have to spend some money out of their retained earnings, their cash supplies, to be able to pull this thing off. Share price goes down to $50. the company is very hesitant to cut the dividend. That's one of the last things they want to do because that'll actually get the share price going on even further. So at $50, a $2.50 dividend is actually 5%. The same $50 put into a CD at less than 1% is, it's gone up. Well, actually, no, I take it back. It's still less than 1%. So $50, 1%, you'd have a 1% dividend on $50 versus a 5% dividend on the $50 stock. Remember, it used to be 100. Dividend was only 2.5%. Now the dividend's 5% because the share price has dropped and they haven't cut the dividend. Let's say whatever they were doing, whatever project that was, they had to take some money out of cash to either fix or expand to try to grow the business into the future. Let's say things get back to normal. Profit margins go back to where they were before. Sales increase or even stay flat a little bit. But when the fear subsides, people are going to look at that stock. Big portfolio managers that manage these billion-dollar funds are going to look at that and go, hey, we can get a 5% dividend. If the share price goes up a little bit, we're going to have a nice return. Since the long-term average of the stock market is only 10%, we're getting 5% in the dividend. We're getting half the long-term average in the dividend. Share price doesn't have to go up a lot. If the share price goes from 50 to 55, they've made 10% on that stock, long-term average of the stock market. That's why dividend-paying stocks have a tendency to perform well over time. But you've got to give them enough time. You can go through when the entire economy is slowing down, sales growth slows down or even goes negative, share prices are going to react much more violently than the actual business values will. In other words, share prices have a tendency to drop more than they should. When they're dropping more than they should, how do you know? Well, the yield on those types of portfolios is going to go up. That's how you know. And you can invest in those companies. If you're doing it the way that I'm talking about doing it, you've only got 10% of your money in that particular sector, and it's split up amongst 4 companies. That means you've only got 2.5% of that portfolio invested in a stock. And you typically don't have all of your money invested in that one portfolio. So now you're really talking about probably having less than 1% of all your money in that stock. That's an extremely high level of diversification, an extremely high level. And by the way, when the share prices are dropping and those stocks are paying dividends and you're reinvesting the dividend, you actually don't have to be adding any money to the account to be increasing the amount of shares you own, because the dividends are buying more shares at lower prices with higher dividend yields. Think about that for a second. More shares, lower prices, higher dividend yields. Oh, wow. That's the end of the show. I thought we were just going to another commercial break. Hey, I'll be here next Saturday morning, 11 to noon. You'll hear every Saturday morning from 11 to noon on WHK 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.